The S&P 500 hitting a new intraday high fueled by a surge in NVIDIA shares. What else is new? The chip maker surpassing Microsoft's market cap to become the most valuable U.S. public company. Joining us now at Post 9 is Rich Saperstein of Treasury Partners. Microsoft and Apple are two of his largest tech holdings. He's ranked number 4 on Barron's list of the top 100 financial advisors of 2024. Made the top 4. Congrats.
Thank you, Scott.
Appreciate you being here.
It's my pleasure.
So for somebody who's been reasonably cautious on the market for many of the conversations that we've had, at record highs yet again now, what are you now?
We're fully invested, as we have been for quite a while.
Okay.
With an overweight in large cap tech and oil. I think the economy is doing well, apart from retail sales, weak earnings in McDonald's or Starbucks or Target. But generally speaking, we've got low unemployment, record high household net worth, record high cash balances, and a Fed that's really poised to be accommodative.
So does that mean you're more positive on the? I get that you're fully invested, but you sound more positive on the market.
I'm always cautious. I'm paid to be cautious.
Yeah, of course you are.
So
that's why you're number 4.
Okay.
You're keeping your clients' money.
I want to keep wealthy people to stay wealthy. That's the main thing.
But see, I'm glad you make that point. I razz you a lot about sort of your view on the market and how you're sort of activating your perspective. Your job, by and large, as the kind of wealth manager you are, is to preserve the capital of the wealthy clients that you have, not go so far out on the risk curve because you're trying to generate these huge returns. Is that fair?
Very accurate.
So how does that then dictate the kinds of things that you're willing to invest in? Mega cap tech, for example, screams to me perfect example.
Yeah, so it's about taking a longer-term perspective. So if you look at the Qs versus SPY over the last 3, 5, and 10 years, over 10 years, the Qs have doubled the return to the SPY. We're overweight Microsoft, Google, Apple, and we've had these names for years. If you think about what's going on now with CapEx and the reinvestment, Amazon, Google, and Microsoft are investing $160 billion in CapEx this year, which is really astonishing, the amount of money. Google is increasing their CapEx by 50% from 32 to 48 billion. So the question really becomes, what's going to be the outcome with all that reinvestment? Our view is that it's going to be productive. It'll lead to more cash flow. And these stocks, even though they're expensive now, you've really got to own them for a long term.
They've driven the market multiple higher, in some cases to some people to uncomfortable levels. Do you think the market's too expensive at 21 times or no?
Yeah, it's definitely expensive.
Is it too expensive?
It's not cheap, but I think investors really should try to have a strategy of, I'm going to own large cap tech, I'm going to own companies that have a change agent, I'm going to own cash flow companies, I'm going to own some defensive companies. So there's a wide range of names that could be held in this market, and even though the overall market's expensive, you still have representation in large cap tech.
I wonder, we had Rick Reeder from BlackRock on the show yesterday, who I guess you could say defended the multiple of the market, and he's liked stocks for quite some time. Let's listen to what he said yesterday, and I'll get your reaction on the other side. Rick Reeder.
I still like the equity market. I mean, boy, it's a heck of a move today, and it's been a pretty profound move. I still think when you boil it down, and I hear all the discussion about is the multiple it turned too high, you're still seeing a historic dynamic around the growth, the ROE, the return on equity companies are creating, and the buyback relative to the IPO calendar. When you marry the fundamentals and the technicals, they're pretty powerful.
Yeah, it ties into a lot of the names we hold. So if you look at buybacks, one of our names is Fidelity, FIS. Talking about a company buying back 10% of their stock right now. All of our companies just about have buybacks in place. In terms of earnings growth, all of our companies are showing year-over-year earnings growth. So the market's expensive. So you can say, look, large cap tech is 37% of the market, yet generating only 31% of their earnings. So there is an overvaluation there, a large presence. But I think you've got to own it. We're fully invested, and we're concerned about how expensive the market is, but where else are you going to be right now?